Okay, as we all know, the interest rates have been rising.
Oh, yeah, I know everything.
They're actually well over 5%. In some cases, they're pushing towards 6%. Now, because of that, there's a rise in applications in ARM loans. I'm talking about the adjustable rate mortgage. Adjustable rate mortgage loans tend to have a lower rate than your typical fixed rate conventional loans. And a lot of people are starting to apply for these loans to help save some money on their interest rate. A report was just done that there was a 14% increase in ARM loan applications just in the past couple of months since these rates have been going up. Now, is this a good idea for you to save a little money now on that interest rate? Because it could end up costing you thousands of dollars years down the road. Today, I'm going to share with you the pros and cons of the adjustable rate mortgage, and this should help you in making that decision of whether or not this is the right type of loan for you. Let's get started. So the ARM loans are making their way back into the picture, and I'm seeing it on the homes that have closed recently. When we see on MLS, you can see how the home was purchased, if it was financed or if it was cash, and I'm seeing ARM show up a lot. Now, the whole point of this is people think you're going to get a better deal and save money on your interest going with the adjustable rate mortgage. Not so much. Let me explain to you how these loans work and what you should be considering. Now, obviously, the ARM loan, they do offer a lower interest rate compared to a fixed rate conventional loan. Now, a popular ARM loan is a 7/1. So it's a 7-year lock-in. You're going to get your rate today. You're going to lock into that rate for 7 years. After that 7-year period, whatever the interest rate is at that time, your rate's going to go up. So a 7/1 means you're going to have the same rate for 7 years. And that 1 means that your rate is going to adjust again once a year for throughout the entire term of that loan. There are other types of ARM loans as well, such as a 5-year or a 10-year, where you're locked into that rate for either 5 or 10 years. Now, you have to be careful because some ARM loans have an adjustment period of 6 months, not once a year. 6 months, that rate can readjust itself. Another thing to think about, once you've reached the adjustable period, whether the 5, 7, or 10-year period is done, you have to see what kind of a cap is on that rate, so it doesn't go above a certain amount. Most of these loans have a 2% cap on the rate. So you can see how this can be a little scary, because once that 7-year period ends, your loan could blow up overnight and your payment could double if you're not on top of this and paying attention to that time period ending. So it can be a little scary.
I am real good in a high pressure situation.
So that's the big risk with getting an adjustable rate mortgage. Now, there are some scenarios where it will work for some people. Number one, if you plan on selling the property within 5 to 10 years, this would be a perfect scenario for you. You could do that if you know you're not going to live in the house for a long period of time. You can refinance your loan at the end of your fixed period, and you can refinance to a fixed rate conventional loan. Another thing to consider, if you really want to do an adjustable rate mortgage, you have to make sure that the rate caps are manageable. You got to look at the worst case scenario as to what those payments are going to be once that fixed period is end. And you want to look at what the adjusted rate will be once it hits the 1-year mark, or if it's 6 months, they're going to adjust it again. And the 2% cap on top of that. Like, look at worst case scenario to see what that payment's going to be, to see if it's something that you can manage. God forbid you're going to fall into that situation. It's recommended to get an ARM loan if there's a big enough spread between the rates compared to a fixed rate conventional loan. If there's not that much of a difference between the rates between ARM and a fixed rate loan, go with the fixed rate loan. Even if you're paying a little bit right now, a little bit more money. Believe me, you want to be on the conservative side. You want to be safe. You don't want to take that chance. So if there's not that big of a spread between the two rates, I would always stick with the fixed rate. Now, I know what people are thinking, and I've been hearing it already. Oh my God, this is going to be 2008 again. The ARM loans are back. These are going to be, it's going to cause people to foreclose because after 5 years, their payments are going to go up and they're not going to be able to afford it and blah, 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 blah. All of that's, oh my God.
What?
If I see any more clickbait out there on the internet, like trying to scare people, I think I'm going to scream. So I'm here to save you, rein you in from clicking on that clickbait.
Thanks for the heads up.
Keep in mind, Back when we had the Great Recession in 2008, all of those mortgages that were being given out, those loans would go to anybody who had a pulse. Sorry to say it, but that was the truth. Do you remember the no income, no job loans? Yeah. You didn't have any income, you didn't have a job. That's okay. We'll give you a mortgage. Remember the balloon loans? Oh yeah, no problem. Yeah, people. That's what caused this problem. And if you disagree with me, comment below. But that's what caused all of those foreclosures. We don't see that anymore. We don't. Since 2008, the banks have been very diligent, very, very restricted on their rules and how they're qualifying people now. On these ARM loans, if you're applying for one, they are very, very diligent about it and very restrictive on their rules. You have to have a minimum credit score in the 700s in order to qualify for an ARM loan. So if you're going to be considering an ARM loan, talk to a lender. Always talk to a lender and get the worst case scenario to see what the highest payment will be. And I'm talking about, again, you want to look at what the payment will be once the fixed period is done, tack on the adjusted period. So say if it readjusts again in a year, and then tack on that cap on top of it to see what the maximum payment will be. You want worst case scenario. God forbid you're stuck in that scenario where the rate goes up and you didn't get a chance to refinance it before the time was up. You want to be prepared for that. You don't want any surprises. One other thing you have to think about, if you want to refinance and you want to try to refinance before your fixed period ends, there could be penalties with that. So it's another question to ask your lender to see what kind of penalties that you'll be charged should you refinance before that period ends. Just talk to a lender about your options. I'm not a lender. Kind of glad I'm not.
Oh, that's so funny. You know, I'm going to pretend that you didn't just say that so we can still be friends.
Nothing against my lender friends out there, but I couldn't deal with mortgages all day. It's just not my thing. Not my thing. I like to go show houses and help people make their dreams a reality of owning a home. So that's it. Talk to a lender to find out what your options are. If you need a recommendation for a lender, I'm happy to refer you to somebody. Just drop a comment below and you can ask me there. And I just want to thank you all so much for watching me today. And if you liked what you saw today, I highly recommend you go check out this video right here. You're going to learn a lot from that one. Thank you so much for watching me today. I am Jackie Baker with Coldwell Banker Realty, and I will see you next time.